Okay, last part for chapter 1. So we'll continue with this accounting equation for number 10, transaction number 10, and it shows us here that we paid down the amount that we owed. So we had accounts payable that we owed of $7,100. We made a partial payment of $900. So it reduced the liability that we owe, and it brought it from $7,100 over here to $6,200. It also reduced cash because we paid out cash. So cash was $5,900. Now it's $5,000. Our accounting equation is still in balance, and that's what we want to see. All right, last equation. So it says the owner withdrew $200 cash for personal use. So we said before we want to keep track of any withdrawals that the owner makes because it decreases equity. So if we look at here, we have the owner that withdrew $200 for personal use. So cash was decreased because they took $200 out of the business, and withdrawals increased. So withdrawals account increased because the amount that was withdrawn increased, just like the expense accounts. But our total equity is actually going to decrease because withdrawals cause equity to go down, and that's what we're going to see in the next slide. So withdrawals is listed as a negative because it reduces equity, and cash was also reduced. So our accounting equation is still in balance. The next slide just kind of shows you a summary of all those transactions, so you have a quick resource. You can kind of glance to see the flow from transaction 1 down to transaction 11 and look at the balances. So these transactions that we did in here are something you're going to see on the practice that we're going to do. So please make some time to make sure that you're familiar with what is in transactions 1 through 11 so that we can review them with ease and you can get extra practice as we're doing the practice together. And then you're also going to see this in the work you're going to do for chapter 1. So it is important to understand. Make sure when we meet live that you ask any questions you have regarding it. All right, next section. We're going to look at what the basic financial statements are and how they relate to each other. So there are 4 financial statements that we're going to talk about. In accounting 1, we learn how to prepare 3 of them. So we're going to learn how to prepare the income statement, the statement of owner's equity, and the balance sheet. We are going to look at what the statement of cash flows is, but we're not going to actually prepare them in depth. So the income statement is showing the company's revenues and expenses, and it shows us whether we had income or a loss over a specific period of time. So we are going to do these financial statements in this specific order too, and I'll show you why. There's going to be information that goes from one to another. So the income statement, the piece that we need to go into the statement of owner's equity is that amount of net income or that loss. The next one that we're going to look at is called the statement of owner's equity. And what it does is it's going to show the changes in that owner's equity or the capital account from the beginning of time or the beginning of the period to the end of the period. And we're going to see the owner's investments, whether we had net income or a loss, or if the owner withdrew anything. So we're going to see that equity and the changes. And the next one is the balance sheet. Again, I said we do these in a specific order because we need information from one to go into another. So the statement of owner's equity, that ending capital balance, that's what we're going to put in the balance sheet. So we have to do that first. And the balance sheet is going to give us the accounting equation. So it's going to tell us the total assets, total liabilities, and the total equity so that we can add them and make sure that our accounting equation is once again in balance. So it kind of gives us a snapshot of a company. And then the last one is the statement of cash flows. And it identifies the changes in the cash account from the beginning of the period to the end. So let's look at what the layout looks like for them. And again, these are in your book, so you'll be able to see them in better detail. But when we're looking at this, and I'm going to try to make this a little bit bigger. It might take, there we go. So we can see that we have revenues minus expenses in the income statement, and that gives us net income. That net income of $4,400 is brought down into that statement of owner's equity, which begins with the balance in capital at the beginning of the period. We add in any investments by the owner. We're going to add in net income, subtract out any withdrawals, and that's going to give us the ending capital balance. That ending capital balance is going to be brought down into the balance sheet under the capital account under equity. We're going to list our assets in the balance sheet. our liabilities and our equity, and we'll see that our total assets are $40,400 and it equals our liabilities and equity. And that must happen. We have to make sure that our accounting equation is again in check. So let's look at our next one. So this gives us the statement of cash flows. So we can see that our cash account was $4,800 and the statement of cash flows shows us the beginning of the period and the end of the period, and we can see what made that change. So the cash flow has 3 different sections. It has the operating activities, investing, and the financing activities. So this allows us to see those changes over a period of time. All right, so just make sure you make yourself comfortable with what's included in each of the financials, what order we do them in. And the last thing, and this will be true in every chapter, there are going to be ratios that we learn how to compute. So for chapter 1, the ratio is called return on assets, and it is calculated by taking net income divided by average total assets. So just a note, anytime we see the word average means that we have to add 2 numbers together and divide by 2. Typically you're adding together the beginning and the ending and dividing it by 2. So return on assets is going to tell us what kind of a return are we getting on the assets that we have for our company. So the example they show here is Nike and Under Armour, and it says that, Nike has a 17.5% return 1 year ago and 19% now. So we have to figure out, well, is that good or bad? Do we want it to be higher or lower? Well, anytime it's a return, we always want the number to be higher. So Nike improved from 2 years ago to 1 year ago, and then again in the current year, where Under Armour actually decreased. So their return went down. So Nike showed a stable pattern, and it has outperformed Under Armour in those 3 years. Now, one thing to note is for the ratios, the hard part is not the math. The hard part is knowing where do we find the information. So net income, we're going to find that on our income statement. Revenue minus expenses gives us net income. And then for average total assets, we're going to find assets on our balance sheet. So we'll be able to look at the balance from the last year or the last period into this period and add those together and divide by 2 to get the average. Okay, this wraps up chapter 1. Make sure you go through, you've read the chapter. It is helpful to try the Smart Book, and just make sure you're familiar with the concepts that are in chapter 1. It'll make our practice much easier, and we'll do the practice based on chapter 1 problems. Thank you, and I will see you again for chapter 2.